A traditional bank vault is a passive steel box for storage. In DeFi, a vault functions as a dynamic, automated engine actively hunting for yield. Around 2020, DeFi developers began building smart contracts to solve the problem of manual yield farming. These automated systems move tokens between protocols to find the best interest rates without requiring user intervention. This illustrates the early monolithic protocol structure. A monolithic protocol is a software design where the fundamental accounting code and the specific risk rules are tightly integrated into a single, unchangeable program. Once deployed on the blockchain, these monolithic vaults ran on a permanent, immutable autopilot. While this automation simplified the user experience, it created a structural trap. Capital remained locked in rigid strategies that were unable to adapt when market conditions shifted. Crypto markets move with incredibly high velocity, where risk profiles and token valuations can change every 12 seconds. When markets become volatile, monolithic protocols rely on a DAO, a decentralized autonomous organization, to update their settings. A DAO is a governance structure where token holders vote on proposals to change variables like loan-to-value ratios. These governance votes often take days to conclude. By the time the protocol updates, the market has often moved further, leaving the system exposed to catastrophic bad debt. Traditional finance manages this volatility by hiring professional human managers to actively navigate risk. This creates a paradox for decentralized finance. Hiring a human manager typically requires the user to hand over custody of their assets, which contradicts the core principle of self-sovereign security. Ultimately, this conflict created a massive development ceiling. DeFi could not scale safely without active management, but it could not accept a manager without centralizing control of the money. Next-generation protocols addressed this by splitting the monolith into a modular architecture. The base layer provides immutable accounting, handling deposits and withdrawals without making strategy decisions. Floating above is the Curator layer, where independent risk managers operate, completely separated from the accounting logic. These professional quantitative teams design strategies, select collateral, and rebalance capital to optimize performance. Decoupling these layers allows financial experts to manage risk actively without ever needing to modify the underlying accounting code. But how does a curator control the strategy if the code prevents them from touching the funds? The curator's interface is a strictly limited control panel. Every action they take is governed by mathematical rules hard-coded into the smart contract. They can adjust specific risk dials, like setting supply caps or liquidation thresholds, to protect the vault during a market crash. However, it is mathematically impossible for the curator to withdraw or steal user funds. The smart contract simply does not provide a transfer button. To add another layer of safety, most systems use time locks. This feature delays a parameter change for a specified period, giving users time to withdraw their money if they disagree with a curator's decision. This trustless mechanism allows investors to utilize a professional firm's expertise without ever needing to trust them with their wallet. The transition to non-custodial curation addressed a significant operational barrier for institutional capital. By removing the counterparty risk inherent in centralized management, this architecture facilitated the entry of billions in professional deposits. Counterparty risk is the probability that the other party in an investment may default on its obligations. We are already seeing this technology integrated into major platforms. Kraken's DeFi Earn, for example, uses enterprise vault infrastructure to route capital into these curated systems. Retail users can now deposit stablecoins on an exchange and instantly access institutional-grade yield strategies managed by firms like Chaos Labs. A stablecoin is a digital asset designed to maintain a stable value relative to a reference asset like the US dollar. The complex on-chain routing, risk monitoring, and blockchain gas fees are all handled automatically in the background. The Curator Model serves as a bridge, turning the technical frontier of DeFi into a frictionless financial product. The modern DeFi vault operates as an actively managed professional-grade portfolio. Traditional asset management relies on trust in individuals or institutions. This modular architecture replaces that trust with transparent, immutable code. By decoupling the money from the manager, decentralized finance has engineered a safer and more efficient architecture for the future of global finance.